U.S. national debt tops $31 trillion for first time. U.S. national debt exceeds $31 trillion. Because of historically low interest rates, America's borrowing spree has long been thought to be sustainable. However, when interest rates climb, the country's budgetary troubles worsen. America's gross national debt surpassed $31 trillion for the first time, a bleak financial milestone that came as the country's long-term economic picture deteriorated due to increasing interest rates. The breach, reported in a Treasury Department study, comes at an undesirable time when historically low interest rates are being replaced by increased borrowing costs as the Federal Reserve attempts to contain fast inflation. While historic amounts of government borrowing to combat the epidemic and fund tax cuts were previously considered feasible by some officials, increased interest rates are making America's obligation more expensive over time. Many of our worries about our expanding debt path are beginning to manifest themselves as we both grow our debt and raise our interest rates. Many people were comfortable about our debt trajectory, in part because interest rates were so low. The latest data come at a time when investors are torn between worries of a worldwide recession and confidence that one may be avoided. Markets rebounded close to 3% on Tuesday, extending Monday's gains and putting Wall Street on a more favorable path after a terrible September. The rise was fueled in part by a government report that indicated a weakening in the labor market. Investors saw this as a warning that the Fed's interest rate hikes, which have increased corporate borrowing costs, may soon slow. According to Peterson Foundation calculations, higher interest rates may cost the federal government an additional $1 trillion in interest payments this decade. This is in addition to the record $8.1 trillion in debt expenses anticipated by the Congressional Budget Office in May. Expenditures on interest might exceed those on national defense by 2029 if interest rates on public debt climb by only 1 percentage point beyond what the CBO forecasts for the next several years. The Fed, which lowered interest rates to near zero during the epidemic, has recently began hiking them in an attempt to slow the fastest inflation in 40 years. Rates are presently fixed between 3 and 3.25%, with the central bank's most recent prediction seeing them rising to 4.6% by the end of next year, up from 3.8% previously. But the federal debt is not like a 30-year mortgage with a set interest rate. The government is in charge. Because the government is continuously issuing new debt, its borrowing costs grow and fall in tandem with interest rates. In a study earlier this year, the CBO cautioned about America's increasing debt load, warning that investors may lose faith in the government's capacity to repay what it owes. According to the Budget Office, these concerns might prompt interest rates to rise rapidly and inflation to spiral upward. Rate hikes might end a brief period of progress in the nation's fiscal outlook as it pertains to the economy as a whole. Both the CBO and the White House forecast that the national debt, calculated as a percentage of GDP, will fall somewhat in the current fiscal year before rising again in 2024. This is due to the fact that the economy is predicted to develop faster than the debt.